In our next edition of It's About Money, we'll be talking about the highly controversial student loans that are piling up for our nation. My guests are from the Consumer Credit Counseling Service of Rochester, so stay with us and we'll be right back. Hello, my name is Nannette Nocon and welcome to It's About Money. My guests today are Chad Rieflin and Andrea Colline, and they are here to talk with me about demystifying student loans. So thanks so much, you two, for being here.
Thank you.
I know you've been a guest here several times, Chad, and I'm happy to have you here with us, Andrea. So let's talk about this big news about the amount of student loans that we owe as a country exceeding the amount of credit card debt. Frankly, I don't think there's anything wrong with that. That's a better kind of loan, but that's just my opinion. So let's talk about that. What are the types of student loans out there?
You're typically going to want to try to withdraw all of your federal funding first, because the federal funding student loans have much more flexible options and they typically have lower interest rates. So that's what any parent or student should be doing, is looking at all their federal options prior to looking into any private loans, as the terms are not as flexible and the interest rates tend to be higher.
Mm-hmm. Correct. And within the federal loan program, there would be what's known as subsidized or unsubsidized loans. Mm-hmm. And what that refers to is the period of time within which the government might pay the interest while the student is in school, and there under which would be known as the grace period.
Okay. So basically, if the student, while the student is currently enrolled, they don't have to pay the interest because the government subsidizes it. And if they continue on to grad school, that they could do the deferral, is that right? Or do they have to start paying?
Right, there's different circumstances which would warrant the extension of a deferment.
I see.
And a lot of that gets into the type of loan that they're utilizing and type of circumstances, time frames, and things of that nature. So they'd have to consult with the loan provider that they're using, with direct loans, et cetera, to see what the qualifications are.
Okay, so we're at the high level, there's the government and the private. So let's talk a little bit about the government. What are some of the acronyms that parents would be hearing, or students, or names of those federal loans?
Well, there's the subsidized and unsubsidized,
Yes.
which I know you just mentioned a bit, but I just want to cover a little on there.
Oh, sure.
The subsidized will not accrue interest while the loan is in deferment, while the student is in college, and the subsidized will. They will accumulate interest over time. There's just different kinds of programs that you can apply for. It just depends on the situation for the student, so it's really important to research prior to applying for anything. One of the things that has to be done first is to completing the FAFSA form. I don't know if that's jumping a little bit ahead, but
okay.
Just making sure that that FAFSA form is completed to determine how much you are eligible for, especially if a parent is going to assist.
Okay, so really you can't really go into government loans without the Fafsa,
Absolutely,
right?
correct.
And then the Fafsa determines what type of loans you're eligible for. Okay, great.
Absolutely.
And so what kind of names of those loans are out there?
Well, there's the FFEL, which is the Federal Family Education Loan.
Okay.
That is something that helps the student while they're in college. Of course, that is the subsidized part of the loan, and that does not accumulate interest while they're there. Then there are, is it Perkins?
There's Perkins Loans, which are, needs-based loans.
Okay, Perkins, okay. So it's Fell and Perkins. Now, there used to be a thing called Stafford. Is that still around?
Yeah.
Okay, all
Yes,
right.
the
So-
Stafford loan is basically, it can be either subsidized or unsubsidized, and that's just the main type of loan that you would apply for when applying for federal funding.
I see. So you can't really choose the federal loans that you can get. I mean, you can choose to decline it.
Yes.
But basically your FAFSA identifies what those types of loans that you're
Right, they're
eligible
limited.
for.
They are limited options, which is really a good thing, because if there was too many options, it can be quite confusing.
Sure. And then let's talk about the private loans, which is like really wide there, right? So tell me about that. Do schools typically have a relationship with a bank? Do you look for your own bank? How does that work?
With the private loans, there's a lot more options of different banks to choose from. It's just, it doesn't, the guidelines aren't federally mandated, so they can have a bit of their own options. Typically, the term is usually shorter, and the interest rates tend to be a bit higher. Not always, but they can tend to be a bit higher. But what you have to be careful with private loans is that once the student is out of college and starts to repay, there are not as many terms that they can qualify for. As far as deferment or forbearance. So if someone gets into trouble, they're not as flexible with repayment options as they are with a federal loan. So that's why it's so important to make sure that you're obtaining all of your federal funding before applying for any private loans that are out there.
Right. With a private loan, you're essentially borrowing money as anyone else would be borrowing money for any other kind of purpose. So
Yes, okay.
you're abiding by those types of rules
Got it.
between yourself and a lending institution versus having the protection of the federal loan program when you borrow from the government.
Got it. It just so happens that when you're the purpose of the loan, education.
Correct.
Instead of buying a boat or kitchen renovation. or
Right. So
something.
with the private loans, your own personal credit is going to be a factor
Correct.
in being approved for those loans as well, versus with the federal loan program, that's not going to be an issue.
So there's really that's more needs based, whereas the other loans are more credit based, right?
Correct.
Correct.
So your financial aid package might say go ahead and find private loans, but if you have terrible credit score, credit history, that could be problematic.
Right. Typically, if a student is applying for the federal funding, it's not a credit-based decision. Private loans are, but the Parent Plus loan is. If a parent is applying for a Plus loan to assist their student, that is a credit-based loan as well. So that's something to be aware of.
I see. So help me understand that. Who actually takes out the loan? If it's a federal loan, is it the student or is it student and the parent?
It could be either.
It could be both.
Oh, I see. Okay.
So the student and the parent or the family together could be borrowing loans that the student is bearing responsibility for, such as the Stafford loans that we just mentioned a moment ago. And then with the Parent Plus loans, they could be taken out for any other additional funds that the student needs that the parents would be bearing the responsibility for.
I see. So the Parent Plus loan is the type that the parents would have to pay for. So if the kid skipped out on that, that's a problem for the parents.
Yeah, it could be a big one.
Because I have heard situations like that where people have co-signed, even not a parent, like a step-parent, and then there was a divorce, and then, then the step-parent is stuck having co-signed when that child doesn't pay, so it's unfortunate. So what happens in a tragic situation where the borrower passes?
With a student loan, there'd be something called a death discharge.
Okay.
So if the student passes away, even in the case of a Parent Plus loan, that loan would still be eligible for discharge, for forgiveness.
Oh, I see. So practically coverage. So we don't need to advise people to get life insurance with regards to their student loans. Is that right? Because it can be discharged upon death.
Right. It's built within the federal loan program.
I see.
Obviously, they'd still need to provide proof, like a death certificate, et cetera, but that is a protection built in.
Okay. So even if it's a privately held loan, is that the case? or no?
The case may differ with a privately
Okay.
held loan.
Right.
If they're federal loans, there is that forgiveness option. But
I
with a
see.
private loan, it may not be. You have to check with the lender prior to obtaining it or just to understand the terms. There very well could be some provisions to protect, but there may not be. So it's important to make sure you understand the terms prior to applying for that loan.
Absolutely. Because also, even after the loan, to just make sure you have adequate life insurance instead of leaving your estate with a loan issue there. So we talked about the underwriting guidelines. What about graduate school? Are the same types of loans available in grad school as it would be undergrad?
It does differ a little bit for grad school. Some of the rules for the types of Parent Plus loans that a graduate can receive, and also the subsidy rules change for the types of federal loans that a graduate student could receive.
I see.
So the rules do change a little bit, but there's still funds available for
see.
graduate students.
Graduate students can usually apply for more, but
Okay.
the interest rate might be a bit higher than a freshman.
I see. And that is the case both for government and private loans, right? Just more money available.
And
Yes.
that's a good point that should probably be mentioned too, is the amount that can be borrowed kind of goes up in a graduated scale from year to year between being a freshman, sophomore, et cetera.
Yes.
The further advanced you are
The
in
more you
your
can borrow.
I
right,
see.
the more you can borrow.
And it's typically not cumulative, right? Like you could borrow so much as a freshman, so much as a sophomore, but if you declined any of the federal loans, for example, as freshman and sophomore, you can't really say, oh, I didn't borrow 10,000 then, I can borrow 15 now. it doesn't accumulate, does it? They just give you an amount over.
Yeah, they'll just give it also depends on what someone's going to school for, and what their
got it.
anticipated income is going to be once they graduate.
I see.
So there's a few different factors in there, but typically it goes higher as the student accelerates in school.
I see. Okay.
But there are some really nice resources out there on the web that use certain types of calculation tools that can help parents and students get an estimate as to what they might qualify for, not only for Pell Grants, but for work-study program and for the federal student loans that we've been talking about here. So they can get a basic idea as to the type of funding, the amounts of funding that they might be able to qualify for.
Yeah, absolutely.
So could you share some of those, and we'll put it on the screen and tell
Sure.
us.
One of those would be studentaid.ed.gov.
Studentaid.ed.gov.
Correct,
Okay.
yeah,
We'll
great
put that on the
resource.
screen. Okay, great. And so that's obviously a government sponsored site.
Yes.
Because
Correct.
there's many sites that are sponsored by
Yeah.
private institutions, right?
Anything with an org.
Yes, that's right. Yeah, right.
.gov,
I'm with
you're
you.
pretty safe with.
Yeah. Or-
Yeah, that's a good point, too. There's a lot of information out there on the internet about student loans, and because private lenders can profit from student loans, folks have to be careful about where they're navigating to and make sure that it's a reputable source or
Sure.
a site that's sponsored by the government so that they know that they're getting
It's true.
correct
Good point.
information.
Yeah, you gotta have that .gov.
And you know you're safe.
Yeah, that's right. Now, how much is the typical amount of loan that a student borrows for undergraduate? Do we have some statistics on those?
We do actually. We have some stats from the New York Times in a recent article. An average debt load for students who are graduating school right now is about $26,600 on an average. So typically, I mean, it could be higher, it could be lower, but the average right now is $26,600.
Okay.
So it's increasing because the schools are more expensive, of course, than they used to be.
Sure.
And typically 1 out of 5 households will have a student loan.
Oh, interesting. So then when they give the average, that's only calculating the 1 out of 5. Okay, so it's not diluting it from the other 4 who didn't need a loan.
Right.
Okay, I got it. I just want to make sure the statistics. So actually, that's not really too bad if you think about it. Many people buy a car and have a $25,000 loan for a car, right?
It's really all about research. I mean, we don't want to deter any student from going to school or going to college. It's important. But knowing the terms of the loan and how much they are going to be getting into versus how much they anticipate as far as income and being realistic. Another point we want to make sure that we take care of as well is taking out more than is necessary. That's something that we see working at consumer credit is, if people, especially if they're trying to go into a graduated plan, are living off the student loan. So they're taking out more than is needed, and by the time they're done financing and paying for that loan, it's going to be much higher, and it's just something to really consider. A lot of people just do it because everyone else does it.
Right.
So knowing how much you need is really key in applying for these student loans and thinking about your future budget and your income.
Right.
So it's really good to stop and think, do I really need to take this money because I have to pay for it?
Yeah,
Just
absolutely.
because it's there, it doesn't mean that you should take it. You know
Yeah,
what
and
I mean?
especially for someone who is independent, someone who might not have any assistance from their family or whatnot, they just assume that they can take the money, and a lot of cases they can, but they can get into trouble later. So it's really important that someone has some kind of guidance or research prior to doing such.
And there's an interesting dynamic that happens where a lot of students don't necessarily have a complete grasp on the loan system, and it's very difficult to understand. So many times they'll actually receive more funding than what's required to pay for their education. And since the school has a hand in managing this process, many times the school is responsible to pay back that overage to the student, and they will refer to it in many cases as a refund.
Yeah. Yes.
So the student, from their perspective, assumes they're getting free money,
All right.
not realizing that this is money being provided to them from what they're borrowing.
Yes.
Exactly.
And
Okay.
unfortunately, in a lot of cases, that money goes towards
Unknown things.
probably the best way to put it.
Stuff,
unknown.
Good time on a Friday.
Absolutely.
I don't think drinking age is a little bit later. But
It's true.
Some-
The word refund can really throw anyone
Absolutely.
off, especially someone who's young who may not have all that experience in managing finances.
Sure, it feels like it's free money. So it's like,
Right.
wow, big allowance available for me here. Yeah.
Like, I thought it was free money. No, I'm just kidding.
Actually, I do remember that. I graduated about 31 years ago, but I remember getting some money in the mail for it. I'm like, what do I do with this? But I just put it in my bank account because I didn't really know what to do with the check.
Right.
And it's like, it's $1,000. What do I do with the $1,000? So, but anyway, you're right. It can be easily spent, and then before you know it, you've paid for it 2 or 3 times over, if you're not paying the interest along the way. So we have lots more to talk about, but we'll take a quick break. My guests are Andrea Colline and also Chad Rieflin from the Consumer Credit Counseling Service of Rochester. We'll be right back.
Every living organism plays a critical role in the planet's ecosystem. Take one away. The San Diego Zoo Global Wildlife Conservancy strives to preserve life, but we are missing one piece. Now is the time to act. Join us, and together we can bring species back from the brink of extinction.
And we're back. I'm Nannette Nocon. It's about money, and my guests are Andrea Colline and also Chad Rieflin from the Consumer Credit Counseling Service of Rochester. Thank you so much. We've had some great discussions here about the student loans. So, so we said that the average loan is about $26,000 for an undergraduate student. When I was in college, again, that was a long time ago, I remember people talking about having been able to file for bankruptcy for loans, but that was about the same time that the government has changed. I don't even know what year it was, but thank goodness you can't do that anymore. Can we talk about that a little bit? What
Oh,
has
sure.
happened
There's quite a bit happening in that area, and some controversy around that particular topic. Right now, as it stands, the only way that a student can actually discharge their student loan debts through bankruptcy would be through a clause which is known as undue hardship. And it's very difficult to qualify for undue hardship through bankruptcy. You would have to be very incapacitated to the point where you could no longer function to conduct the work that you were trained for through school. So there are very few students that end up being able to discharge their student loan debts through bankruptcy.
The important lesson here is if you borrow that loan, even if you get a refund, make sure that you have the ability to pay it later, because it's kind of like a tattoo. It stays there, right?
Never goes away.
Although maybe a tattoo can, but the student loan you cannot,
Yeah,
right?
the tattoo would probably go away quicker.
Yeah,
Student loans.
okay.
And the other thing about student loans and credit is student loans are one of the items that can be reported on your credit report indefinitely if they're in default.
Okay.
Until they're restored once again, until you're back on time.
I see. So that can really hurt your application for a mortgage or a car loan or whatever else.
Right, or furthering your education. That's
Right.
a really big one as well.
Sure. Now, speaking of credit, I mean, it could be an advantage to have a student loan, right? So
Absolutely. It helps a student to establish a credit history when they're borrowing and repaying. So it's something that could create a credit history, therefore creating a score, and it can assist the student. I hate to say good debt, but it could be a good debt to have. It's better than having a whole bunch of credit card debt or debts that are accumulating higher interest rates because of the low interest rate in the repayment term, as long as it's being paid on time. But if they're delinquent or they're falling behind and they're not doing anything to try to resolve that, it can really hurt the credit report too. So it's a fine line. The good thing about student loans is that if someone is having a hard time making payment, if they have a federal student loan, there are some options, there are some flexibility for them to stay on track. And even if a loan is in a deferment or a forbearance for a while, it won't hurt the score because it's not being delinquent, it's not behind.
Exactly.
So it is a good way for someone to help establish credit, but you have to be very careful with repayment. And if there's ever an issue where someone can't, they need to be in immediate contact with the servicing agency.
I see. And also some of these loans can be repackaged, right? Because you could have 8 different loans if you're taking a separate loan. Yeah, right. What can be done? Consolidation, like you said.
Typically, many loans can be consolidated, so it's within the same package, and the interest rates are lower. But you do have to be careful with consolidating.
Definitely. I think one thing that you really want to be careful of with consolidating is consolidating your federal loans into private loans. If you do that, you're immediately going to lose all the advantages that you have with the different repayment options with federal loans and the rules that apply to the federal loans.
I see.
So there's some heavy warnings around taking that sort of action.
I see, because you also give up the discharge in terms of if you died prematurely before the loan is
Quite possibly, sure.
other things. Okay, right. So someone might make a mistake if they go to the wrong website and think that they're consolidating all their loans in a positive way, and they could possibly be hurting themselves.
It could happen, especially if someone, again, is on the younger side and they just don't have that experience in managing finances and think that, oh, well, maybe this interest rate's lower, or this company seems better, or I can make it work here. But if something changes within a year, they can really get in trouble. So it's very important to do your research and ask all of your questions in reaching out to the agencies prior to doing any big movements.
Okay. So early in 2013, we're still at low interest rate environment. So chances are anyone going to college today borrowing money is borrowing at a lower rate. What are the typical rates that you would find spring of 2013 rates?
Well, it's depending upon the kind of loan. Right now for the subsidized, I think it's around 3.5%, while subsidized are around 6%. Some private loans can get up to 9%. Some are lower though too. It just depends on which organization you go with. But right now, subsidized about 3.5%, and the unsubsidized are about 6.5% or so.
Okay, so subsidized is lower, and then the unsubsidized is higher.
Correct.
So, but we do say that in terms of the subsidized, the government pays for the subsidized rate
While they're in school.
While they're in school, but it's a more attractive rate anyway towards the end. So, but think about even if an individual can pay for the entire education, that there are benefits to taking a loan out.
Yes. Oh, absolutely.
So let's say a situation where someone has some money to pay larger than the monthly payments. If they make an advance payment on student loans, do they give them a break if they cannot pay for a certain period of time?
Not necessarily, but there's still an advantage to doing that, to paying ahead of time.
Okay.
Because with student loans, as it would be with any other kind of loan, the longer that you pay for, the more you're really paying in the end.
Yes.
So a typical repayment term for a student loan would be 10 years or 120 months.
Okay.
And many loans have the option to extend up to 25 years.
Got it. Yes. I've seen that with vet school and dental school loans.
Absolutely.
Like, oh my goodness.
So the advantage obviously would be that if you extend for that period of time, you're going to have a much lower payment, which is going to make your cash flow situation much more positive. But in the end, you're paying a tremendous amount more for the interest. So going back to your question, if you pay more upfront now because you can, you're going to shrink the terms of that loan, and you're going to pay a lot less in the end.
Sure. So you can use it as a flexibility tool if cash flow is a little tight in the beginning, and then just increase your payments towards the end. But if you keep it at the low level for 25 years, that would take a long time. And then your children are going to college. That could be pretty interesting. So these days, what happens when let's say a student defaults on a co-signed loan? Let's say whose credit is affected? Is it just the student, or is it the student and the parent, or the co-signer?
Both. Whoever's involved with the loan will have the delinquency upon their credit report. So if you are co-signing, you may as well pretend it's your loan as well, just in case there was a situation to where someone couldn't pay. You can either pick up the payments or contact the servicer for some options to put the loan in deferral or forbearance, just to stay on track with that.
I see. So if you consider co-signing, very important to stay in touch with the other loan of the borrower so that you know what they're doing. Because then it could, or you could actually check your credit report, right? Because that would show up.
But if you're co-signed, you would typically receive notification on both ends, because both of your names are in it if the loan was to fall delinquent. It's just still important to have the communication with, in most circumstances, your children, to make sure that things are being paid on time.
Sure. But if it's someone who's not a child and living in a different address, they could, the co-borrower might not be getting notice of that, right?
Right. They should be, but in many cases they don't. So it's important to keep in contact or continue to monitor your credit report.
Or submit a change of address or something like that.
That would work as well.
Yeah, very important. So then important to check your credit report, right?
Definitely. And sometimes folks will set up their own arrangements to make sure that as the co-signer, things are going to stay on the up and up. Sometimes family members will have their child, even though they're the primary borrower, they'll make the payment to the parent who's the cosigner, and the parent will make the payment
Yes.
on the loan.
That arrangement works well.
Yeah.
I see.
Having a 30-day delinquency upon the credit report will really bring this credit score down a lot.
I see.
So we got to be really careful with those. Typically, student loans don't report until 60 days, but not always. So you really want to stay on track with those.
I see. Okay, so really important to check that annualcreditreport.com, right?
That's the one?
Yes, annualcreditreport.com.
Because that's the freebie, right? That's
Yes,
the freebie.
that's
and
the
you can
correct
check
free
it.
one.
Correct free. Yes, you're right. You know, you'll say, I have to pay. Well, only for your credit score.
Yes.
But you can check the history of the payments, right? If there's a delinquency.
Right. At annualcreditreport.com, you're going to get all the information
Oh, is
about
it
what's
right?
on your credit report.
Okay, but not your credit score.
Not your credit
Okay, yes,
score.
and then you have to pay for that, right?
You've done
That's
your
right.
research.
Yeah. Well, he's been a guest a number of times.
Wonderful.
So do you suggest that someone, any loans that are subsidized, is it immediately reported in the credit history right away? Okay, so even though as a freshman,
Yes.
you should really be checking your credit report, right?
It
Okay.
wouldn't hurt at all just to make sure that they are within a deferred status and that they're being reported correctly as far as balances and such.
Okay.
And it gives the student a good opportunity to see what a credit report looks like and how to pull one so
Mm-hmm.
that they can get in the habit of obtaining their report as well.
Now, where can students find resource information to understand these kinds of things and the ideas that, check your credit history, make sure you check your cash flow, your budgeting, so you know how to pay for this? Are there any sites like that available?
They can visit our website.
Okay.
I was going to say the same thing.
All right, very good. Now, no, actually, so your organization is a non-for-profit organization,
Correct.
right? And funded by,
Well, typically paid through grants, donations, funded through some of the creditors that we work with on a daily basis. So.
right? Because the objective is to help consumers make sure that they're on time, that they're paying their loan back, and being
Right.
responsible for it.
And we've got many different forms of counseling that we provide now. Of course, traditionally, we've always done credit counseling and budget counseling, et cetera. But along the lines of this topic, a few months ago, we also developed student loan counseling.
Oh, is that right?
So we work directly with borrowers who are trying to get all of this sorted out, which can be very in-depth and complicated, as we've heard here today. And we help them to figure out what repayment options are available to them, what would fit best with their budgets, and we help them to work through that process to get back on track again.
So
I see.
typically looking at their income, their expenses, we'll pull a credit report to kind of see where they stand, take a look at what kind of loan that there is and see what options they may have. We'll go on the website with them, help them navigate, just to see what can they do. So they either don't fall behind with the student loans, or they can stay on track and have it not, impact their credit, or in some circumstances, if someone hasn't paid their student loan for quite some time, what can they do? Because that happens all the time as well.
I see. So instead of putting your head in the sand, it's better to
Help could
address
help,
it.
and sometimes it's hard to do it on your own. So if you need to reach out and get a little bit of assistance, we'll be happy to help.
I see. So is it more of a crisis situation that one wants to come to your organization, or is it more like, I'm beginning to borrow loans, I'd like to get a little bit more information?
Both.
Okay, good. That's good.
Absolutely.
And is that the kind of service that the consumers pay for, or is it the subsidy that's provided? How does that work?
If someone is doing a student loan counseling session, because there's a lot of time involved, there is a fee for working with an individual. But if somebody just wants to come in and in many cases just go over their budget, their credit report, and looking at some options to help them, there's no cost to that.
I see. Okay, great. I almost feel like for every client that I have, a student going to college, that I should inform them about your website and then tell them about the service available. So
Parents as well.
Yeah, of course, yes. And they could responsibly think of what they're going into and what their options are later. Because usually it's like a panic attack at the end, and now it's time to pay, and they see this long list of loans that they have borrowed, and, oh my gosh.
Yeah, it's scary. It really can be a scary thing. And a lot of kids are deterred from even going to college because of the scare of owing that much debt.
Sure.
Right. But then if you look at it as a return on investment, right? I mean, you borrow money and you hope that you increase your income potential in the
Absolutely.
future, so that the loan itself is a good investment.
That's
that's-
probably one of the best ways to look at it nowadays as well, this is an investment into your future earning potential. So what's the best investment to make based on your future earning potential? So a lot of the advice we tend to give up front to students who are going to be borrowing is to also consider their job potential, that income that they'll be receiving compared to what they're going to be borrowing, and what's going to be the wisest track to follow to get to that end point.
Yes.
And it's not always the traditional means that are going to be the wisest way to get there.
Great, wonderful. You two have been wonderful. Thank you so much, Andrea. Thank you, Chad.
Thank you.
I appreciate, I think our viewers have learned quite a bit about student loans. Important thing is we can follow up with the website.
Absolutely.
So thank you, our viewers, today for listening and watching our program. And my guests were Andrea Colline and also Chad Rieflin of the Consumer Credit Counseling Service of Rochester. I'm Nannette Nocon. Until next time.
Thanks for tuning in to today's show. If you have any questions for It's About Money, please email Nannette at nnocon@aol.com. This program was produced through Penfield Community Television in Penfield, New York.